Hi, everyone. Welcome back to Seven Figures, where we discuss and compare the growth portfolio versus a dividend portfolio versus the Bogleheads portfolio. So my overall portfolio has now reached $11,640. Last episode, it was sitting at $8,000 combined for all three investment styles. And today's episode, I'm going to talk about Bogleheads disappoints. I'm a Boglehead myself, and I always read the Boglehead blog, and I might post something about this later on. But the past week and a half has been very volatile in the marketplace, and it's been a great opportunity to see how the dividend portfolio strategy works and how the growth portfolio reacts. I think most of us would anticipate that there'll be a lot more volatility in growth, and therefore you would likely see big declines when the market is on a decline. And many of us, and especially myself being a Boglehead believer, would have thought that this would be the cooling portfolio, the one that you don't have to worry about, set it and forget it. It's 50-50 stocks versus bonds, and it's very, very diversified because the stock portfolio has over 7,000 stocks in it. But I'm going to go through all three funds and all three portfolios actually and show you how they did. We had pretty big news this past week in terms of one, the Federal Reserve did decide to cut the Fed funds rate. It has been earnings season, so you've seen positive earnings from some companies, and yet they still go down. You could see that from AMD, which reported great numbers, but didn't give good guidance, so the numbers went down. And he had some companies that reported average numbers, and they went up because they gave good guidance. But lastly, the other thing that we had that really caused a lot of news was President Trump putting tariffs on China, additional tariffs, I should say. And the market went down, everything went red. But I'm not really worried about it. In fact, I welcomed it because that's a great opportunity to start buying stocks at a lower price. Keep buying the companies that you believe in at even lower prices. Now, I don't really look at any of these as just stocks. I see them as businesses that I'm owning a piece of. So it doesn't change my position. In fact, I'm starting to have $50 go into each one of these portfolios every single day. It started last week where every single day, $50 went into each of these portfolios. So that's $150 a day going into the market automatically, something that I really love about M1 Finance. So rebalancing, buying some of the stocks as they go down, which means when the market does turn around and starts realizing the real value of these portfolios, all these stocks, all these companies, you'll get bigger returns. So I enjoyed it, I welcomed it, and I hope most of you did. Now I'm going to turn my attention to giving you all the update on how the portfolios did. We'll start off with the dividend income portfolio. The dividend income portfolio has actually weathered the storm pretty well this past 10 days. As you can see, right now it's up 0.65% since we started it, and that equals $13.86. Of that, $8.83 of that came from dividends, which is very important, and $5.53 came from market gains. That's impressive because pretty much the whole market has been headed downhill since all the news about tariffs, rate cuts, and earnings have come through the last 10 days. With this portfolio, it does have all the sectors similar to how the S&P 500 is built. I've shown this in the past, starting with communications, having 4 different stocks, alternatives, 5, consumer staples, 4 companies in it, technology, 5 companies, consumer discretionary, 5 companies, REITs, 4 companies, energy, 7 companies, industrials, 5 companies, utilities, 5 companies, healthcare, 6 companies, financials, 8 companies, which is an area that I really believe in. It's still not up as much as it should be. And then lastly, bonds. One thing I do realize why this portfolio may be doing better than the average index is because it only has 57 stocks, whereas an index has 500 stocks. And I've been careful in selecting the companies that I really do believe in and companies that pay dividends, which means companies that have good, stable earnings and profits. So that's one of the reasons why I do like about M1 Finance. You can kind of build your own index fund, but get to select exactly what you believe in, companies that you know you're familiar with, that you've done research on, as opposed to having every company that makes it in the 500 largest companies in the US. So it's pretty much like an S&P 500 index for me, but I think it's weathered the storm better because all these companies are mature, established, dividend paying companies with solid earnings. Some of them may go down, but a lot of them are, the leaders in their space. I'll get a chance one day to, if I have more time, to go through each one of these slices and show you the companies that I have in there. But you can be rest assured they're all pretty much blue chip or close to blue chip companies that you're probably familiar with. But this has done extremely well in the last 10 days, and I'll show you why, especially comparing it to other portfolios. I'll switch over now to the growth portfolio. But here it is right here, the growth portfolio. Um, it only has 11 stocks in it. And sure enough, it's down 1.7%. At one point, this portfolio was up 12% just 8 days ago. When the market was going up really fast, it was going up really fast. Down $38, not a whole lot, it's not going to change anything. But some of the big swings have happened down here in Beyond Meat, which was up 50% as of like 6 days ago in here. Now just up 5% after reporting their numbers, which were great numbers. But then they also reported adding more stock, secondary offering, which means they're going to be putting more stocks on the market. And that drove the stock down. They also didn't become profitable, which some people in the market thought they were going to report net positive earnings, and they didn't, but they grew their revenue significantly. Another negative driver was obviously Amazon. Didn't report the best numbers when it comes to profitability, but still great top line numbers. Earnings was still going positively. So I'm not worried about that company. Facebook reported great numbers, but somehow got punished, and now it's down 5%. They reported fantastic numbers, and then all of a sudden the stock got caught up in all the news that hit the news stream and just got pulled down. So great opportunity for me to get more shares of this great organization at a lower price. Alibaba, which does most of its business in China, not going to be affected by the Trump tariffs because all their business is mostly in China, and Chinese people can keep buying their goods. So I'm going to be getting this company at a discount, and I'm happy about that. The market irrationality is my profitability. And then Uber, probably deservingly so, to be down negative. They're still not profitable. They're growing their top line pretty fast, but not as fast as some of the other companies. However, they're still not going to hit profitability for a while. This is more like a bet for me based on a good product. I use Uber all the time. I enjoy the service. And so why not put my money there? And then AMD reported great numbers, still got punished because they didn't give good guidance. And guidance, that's something for Wall Street. For me, it's all about the business. How is it doing? And most people who do keep up with technology probably know that AMD is absolutely eating Intel's lunch. They're coming after NVIDIA pretty aggressively, and they're catching up with them too on the GPU side. But when I look around, it's their 7 newton meter product is better than what Intel has to offer, and they have pricing power. So it's just a matter of time before AMD goes right back up to where it should be because it's a highly valued company. It's doing great things. The business is really healthy. I'm not worried about it. I'm happy to see it go down so I can buy more shares. So that's really it for growth. It's down, but as expected, I don't think that a portfolio with companies that don't pay dividends, that are still in a high growth phase, are going to get rewarded when the market turns negative. These companies are going to grow really fast when the market is doing well, but their businesses are going to continue doing well even if their stock keeps falling, because at the end of the day, at one point they'll all become like Apple. They'll all stop paying dividends. They'll be mature and be able to pay out things. Of course, I'm a little bit worried about Tesla because it is a car company and the car business is highly cyclical. So you hope it gets to profitability before the cycle changes to one that's negative, because car companies are exposed during negative cycles. Now I'm going to take you to the last portfolio, the Boglehead portfolio. And here's the big disappointment for me. I'm a Boglehead myself, and I was really a little heartbroken to see this kind of performance, even though it's only been 4 weeks since I started this experiment. This is supposed to be the portfolio that gives you like, you sleep well at night because it's 50% total world index fund, which has got 7,000 stocks in it, and in the total bond market, 50-50 split, right down the middle. Uh, this is supposed to be the kind of portfolio that you get into when you're like in your 60s. All safety, gives you some growth on the equity side, and then protects you on the downside with all the bonds. But never in the past 4 weeks has this portfolio gone up above 1% growth. And when we had a downturn or some negative news going through, it's gone down 1.13. So it's actually, when I look at it from a risk adjusted return standpoint, it's actually more volatile and more risky than the other portfolios because it's not giving me the upside that I need during good times, but it's showing me that it could go down even more during bad times. So I think it's only 4 weeks. I'm going to give it a shot because it does include companies outside the U.S. and the rest of the world has been weaker than the U.S. So maybe that plays a part in it. But in the long run, this stuff is supposed to even out where this portfolio is supposed to be outperforming the others when it comes to giving you risk adjusted return. At least that's based on The Intelligent Investor by Benjamin Graham. So anyway, that's really it for today. I'm really disappointed in the Boglehead portfolio. I thought I would highlight that. As you can see, in terms of money here, $6.20 from dividends, but negative $33 from market gains, mostly coming from the equity side of things, or all of it coming from the equity side of things. A little bit disappointed by that, but that's really it for today. If you like the content, give me a thumbs up. If you like the concept and the channel, please subscribe. Thanks for watching and have a great day.